What if I told you that you could buy a rental property without spending a single dollar out of pocket and at the same time pay off your own mortgage even faster? No tricks, no gimmicks, just pure math. In this video, I'm going to run the numbers for you step by step and show you exactly how this works. Quick note before we dive into this video, it is strictly educational. Everyone's financial situation is different, so make sure that you consult the proper professionals before implementing a strategy like this. With that being said, let's jump in. All right, for anyone who is familiar with the channel, you know that this is a rental cash damming calculator, using the income from our rental to also help us pay off our primary residence mortgage faster through debt conversion. So the one thing we're going to do differently today is we are going to show what happens if this client uses their line of credit to fund the down payment on a rental property and the total benefit that they are going to get from running a scenario like this. So focusing first on the left-hand side of the screen, we have this client's primary start value at $750,000. Mortgage balance of $500,000. We are expecting a rate of 4.44%. They have 25 years remaining on their amortization. This gives them a monthly payment on the mortgage of $2,750.71. Because this client has enough equity built into the property, they can access a readvanceable line of credit. And in this case, if the purchase price is, if the primary start value is $750,000, the maximum LTV to have a readvanceable line of credit is 80%. So that puts it at $600,000. That means we have $100,000 of room that we can use for the potential line of credit. In this case, if we go a little bit farther down, we see that they can take $90,000 out of this line of credit and use that for the purchase of a rental property. Now, in this case, I'm going to factor in $80,000 for the down payment and also include $10,000 for closing costs. So there truly is no money out of pocket for this client. At today's interest rates, this line of credit interest is 5.2%. The monthly cost of that line of credit is $390. Now we go down to the rental property itself. At an $80,000 down payment, that allows us to buy a property worth $400,000, mortgage balance of $320,000. On a rental property, our interest rates are going to be slightly higher. So let's say 4.89%. Over a 30-year period, that gives us a monthly payment of $1,686.85. It's not just the mortgage payment on a rental property, though. There are other costs. So maintenance and insurance, let's say $150 for maintenance, $150 for insurance. Because this is a single-family home, there is no condo fees, and the client is going to self-manage this property. So management fee is not included. If either of those are applicable, we would just add them into the calculator as well. And in this calculation, we're also assuming that the tenant is covering off utilities. And property taxes are going to cost the client $333 per month. So a total monthly expense of just the property of $2,320.18. But I haven't forgotten the true cost of this rental is actually $2,710 because we do have $390 that has to be factored into the cost. Now we go over to the cash flow side. $2,500 is around the rent that we can expect for this property. So it's enough to cover off the rental expenses of the property, but slightly short of fully covering the investment line of credit. I'll come to that in a second. I'll quickly just take us through the assumptions that we're making, and then I'll walk you through a breakdown of how the cash flow is going to work and then the financial benefits from running this scenario. So we are expecting our rental property to appreciate at a 2% rate per year. This is going to be annualized, so some years it's going to be more, some years it's going to be less. Cash flow, we are expecting it to appreciate at 2%. This number also calculates the expenses going up by 2% per year. And then we are expecting an 8% investment growth rate once we have our mortgage paid off, and these clients' marginal tax rate is 36%. So now let's shift over to the cash flow cycle and how these funds move through a client's home. So traditionally, when we are talking about a client who has a rental property, what they always do is take the rental income and then directly pay their rental expenses. So the money comes in and we service our rentals. This is how 99% of landlords do it in Canada. But we are missing out on an opportunity to make our money more efficient. What we do with rental cash damming is we first take our rental income and we prepay the client's primary residence mortgage. What we have now are two components that go towards paying down the principal. We have that $2,500 of rental income coming in, and then also a portion of our regular payment is going towards servicing the principal payment. Now in rental cash damming, we are pushing the income through and then reborrowing to service our rental expenses. And now we would have prepaid the principal amount, the $2,500 prepayment, and then reborrowed $2,320 from a home equity line of credit and serviced our rental expense. And then within that home equity line of credit, I mentioned that I would take care of that $390 payment. It is serviced by itself. We basically wait to cover off that home equity line of credit payment until the primary residence mortgage has been fully converted over to a tax deductible loan. At that time, we will then take our regular mortgage payment and have it pay down the home equity line of credit in totality. So what are the benefits from doing something like this? By using the home equity line of credit, $90,000, to buy a rental property and then go through a cash damming cycle. So walking through the financial benefits of running a scenario like this, rental cash damming, as well as the purchase of the rental property itself. From a rental cash damming standpoint, the first big milestone is, if you remember, we had a $500,000 mortgage balance. In 9 years, that is converted over to a tax deductible loan. Because of that tax efficiency, we are now able to recoup $108,000 that would have gone to the CRA. Using these tax refunds, we assume that you're going to use that to further prepay your mortgage as well. And using those tax refunds, we are able to reduce future mortgage payments by 30 monthly payments. Say it another way, we don't have to make $82,000 worth of mortgage payments. It also can factor in, by you paying off your primary residence mortgage, approximately 2.5 years faster. So this is outside the benefit of having the rental property itself. Simply by rental cash damming, we can pay the mortgage off 2.5 years faster. But of course, because we use the home equity line of credit to purchase a rental, we now have this extra property that we can add to your net worth. So on top of the $91,000, so this is the $82,000 invested at that 8% over that 2.5 year period, that number becomes $91,000. If our rental property of $400,000 appreciated at 2% per year, it's now worth $657,000. So if we take those two numbers minus the mortgage on the rental property, we can improve your net worth by $660,000. In a short amount of time, we would have your rental property fully paid off, and you would have two properties totally paid off, one now generating you an income. And at the very beginning of this, we never had any money out of pocket to start. You've just seen how powerful this strategy can be when the numbers line up. Buying a rental property, paying off your mortgage faster, and doing it all without a single dollar out of pocket. Now, if you would like me to run a personalized scenario for you, I offer this service completely free of charge. Just click the link in the description below and I'll walk you through the numbers for your specific situation. Don't leave potential opportunities on the table. Reach out today and let's see if this strategy can work for you. And if you enjoyed this video, you're gonna love this one as well.